Hey, good morning, it's Owen Bigland. This is the Inside Edge video blog. There's a lot of you people know that have been watching my blog for a number of years now. You know that every year in the fall, October or November, I go out to Manhattan, to New York City, to an investors summit. I've been going to this for probably the past 9 years now. This is, I think, my 10th year. And every year I like to do a little video blog on this, on some of the takeaways that I learned from my recent trip to New York. Now, a little background on this. I'm fortunate enough, I've had a few mentors in my life over the years, both in real estate, of course. I've talked about my father, and I've had others. I've also had several mentors in the private equity, hedge fund, financial community that have helped me out over the years with my investing philosophy. And I'm fortunate enough to have a pretty good friend that every year invites me out to his firm's investment conference. Now, this investment conference is for their high net worth clients. High net worth meaning, I think the threshold is about $25 million or more that these guys have to have. Now, I'm not in that league, that's for sure. Let's get that straight. But he allows me to sit in on the Saturday session. They meet for 2 days. And then they split off to their individual advisors that meet one-on-one. But for a Saturday, from 9 a.m. till about 3 o'clock, they hold up shop in a hotel in Midtown Manhattan, and they go through what they see for the stock market for 2017, some of their holdings. They talk about political risks, and they talk a bit about real estate. They'll have a segment in there on real estate, and just their overall investing philosophy moving forward and what they see. So I learn a lot from these. I mean, I've been involved in stock investing. I bought my first shares in my first stock that I ever owned was Pepsi, which I bought close to 30 years ago. So I actually bought my first stock before I bought my first piece of real estate. But, and I've blogged about before, I'm a value investor, I'm a buy and hold. I buy blue chip companies that pay a nice dividend, increase the dividends every year. I also index invest through ETFs. Now, one of the best things about attending this every year is I'm able to mingle and socialize a little bit with some of these high net worth clients. Now, my friend will always tease me that, you know, hey, sit at the back, and during the coffee breaks, you're welcome to strike up conversation, but don't start asking a bunch of dumb questions. But it's a kind of a running gag we have. But because you know, I'm not in the league of these guys, but you know, I end up talking to a few of them every year during coffee breaks, and these guys are business people, you know, in all walks of life. Physicians, they own car wash chains, or most of them are entrepreneurs to some extent. Some are CEOs of companies, and they have this firm managing their money. Some of the takeaways I get from these guys, and I've noticed this for a long time with people that are successful, is, you know, they're not glued to the day-to-day market fluctuations of what's going on, whether it's the real estate market or the stock market, or what's going on with political activity here or there, or Brexit or the Zika virus. It doesn't influence their investing philosophy. A lot of people think that people need to be busy, always buying and selling and analyzing to be successful financially, and that's not the case. Most of these guys are buying quality. When it comes to the stocks, they're buying quality blue chip companies, Apple, Johnson & Johnson, Procter & Gamble, and keeping them for long periods of time. When you get a correction, they look at that as a buying opportunity, not as an opportunity to sell. They also take those dividends or those cash flows that they're getting every quarter and then redeploy them and reinvest them into more stock, like a snowball effect. They do the same thing with real estate, because in talking with these guys, a lot of them own a lot of real estate. Some own multiple residence and pied-à-terres in various cities. But a lot of them own rental properties, apartment buildings, single-family homes. And it's the same thing with them. With that, they buy them and they hold them for long periods of time. When we get a correction, they're always looking for corrections if they can get one, because they're fantastic buying opportunities. So it's something that I've noticed for a long time in being around these type of people. It kind of reaffirms my thinking, because that's the way I've always worked, and how my dad always taught me is, you know, don't fiddle with stuff. And you know, in a lot of these conferences, and if you read books on some of the best financial minds out there, Peter Lynch and George Soros and Jack Bogle and Warren Buffett, you know, a lot of these guys, as the first advice for people is to buy your principal residence. And most of these money managers in New York will tell you the same thing, really. That's kind of the first step, because it sets you up for so many financially liberating things down the road. You're creating equity. It sure beats renting. You can tap into that equity. The other thing, of course, is you're using really the biggest wealth creator there is, and that's leverage. I don't think there's anybody in this room in New York that I was sitting with that has built their fortune without using leverage, meaning that a mortgage is a prime example. You're able to buy an investment property, let's say for $500,000 with $90,000 down of your own money, borrow the other 410. That's leverage. You're now taking possession of an appreciating asset for 20% of your own money. And I don't think there's any wealth that's ever been built in this world that hasn't used some form of leverage. Now, you don't want to overdo it on leverage. You don't want to overextend yourself so that if interest rates went up or you lost your job, that you're forced to liquidate that asset. But controlled leverage, like mortgages, is really the way most wealth was built. Most of these guys in this room in New York had started dry cleaning businesses with one property, took out a mortgage, bought a second one, and went from there. And it'd be very difficult to create any type of financial success or retire early without using leverage. Just working from paycheck to paycheck and trying to save what you earn is going to be pretty difficult. You need to make your money or supercharge your money by using leverage. And one of the easiest ways or simplest ways to do that is by buying real estate and taking out a mortgage. It's much tougher to use leverage in the stock market. You'd have to get a margin account, and interest rate on it is higher. It's also pretty dangerous as well in the stock market. So that's just one of the takeaways. Thought I'd share with you guys. Again, you know, successful people, wealthy people that have built any type of wealth, they are buy and hold all the time. Every time I meet them and strike up a bit of a conversation and get a feel for where they're at, it always strikes me as the same thing with these guys. They're not flippers, they're not speculators, they buy and hold quality assets, stocks and real estate. And when you can start when you're in your 20s, it sure makes life a lot easier when you start getting into your 40s, when you've got the cash flow coming from your revenue properties, you've got the dividends coming in from your stock portfolio, and you're reinvesting those dividends and rent checks. So in my book I've got coming out, I plugged it a few times here. That was the other reason why I was out in New York. I had a final meeting with my publisher for a final editing of my book, and a meeting with the co-producer of my book here. I'm writing this book with a partner who is a financial writer in New York, and you know, we went through, we've got a chapter in my new book that we call the ghost ship principle. And I think people have never seen anything like this before, because I'm going to give you real life examples in Vancouver about buying a property as an investment, using leverage, putting 20% down, borrowing the other 80%, putting a tenant into that property, and then just doing nothing. Sure, every year or two you're going to have to get a new tenant in there. Every now and again the toilet's going to break and you're going to have to fix it. But it is amazing what you can do by just buying that property, getting a tenant in there, and what we call the ghost ship principle. Set that asset out to sea, let time, let your tenant's checks come in and pay off your mortgage, and what that'll do for you in 20 or 25 years. In 25 years, that $500,000 condo will be worth 1.5, and hopefully you've still got a tenant, you're keeping it. That $3,000 or $4,000 a month at that time, or $6,000 a month he's paying you for rent, which is probably what rents will be 25 years from now on a one-bedroom, is just free cash flow coming into you. Now all of a sudden you don't have to work for a paycheck. If you've got a couple of these properties and then you've got dividends coming in from your portfolio, now life becomes pretty sweet. Now you don't have to rely on a paycheck. You've got passive income coming in. And I think you're going to learn a lot from the book that I've got coming out here. It'll open up some people's eyes to what you can do, especially when you start at a young age. I'm Owen Bigland. As always, thanks for watching. I'll see you next time.